We just finished May and I made over $1,000 in profit this month for my 4th month in a row with over a 75% win rate. So today I'm going to be taking you through a few of the trades that I made, and then we're going to talk about some trades I'm looking to make in June. This is a spreadsheet that I'm using to track every single trade that I'm making. You can find it in my Patreon, which is going to be linked down in the pinned comment below. But again, in May, we made over $1,000 in profit with $1,102 in gains for May. In April, we made $1,300 in profit. In March, we made $1,400 in profit. In February, $2,100 in profit. In January, we did end up losing money, $1,200, because we bought a bunch of call options right before the bear market started. But overall for the year, so far, we've made $4,700 in profit. And here's the trades that I made in June. Now, I'm not going to take you through every single trade that I made this month because then this video would probably be about 2 hours long. But I am going to take you through my biggest winner, my biggest loser, and then the trade that I wish I had held on to for a little bit longer. So if we go over to my May trade stats, my biggest loser for this month was $620. This was on a QQQ call credit spread that I had opened on May 25th. And if we go check out the charts on QQQ for May 25th, it had been trading for around $292 after recovering from a low of $280. And the reason why I opened this is that I thought this was going to be a classic bear market rally where we see a little bit of a bump and then the markets would continue to slide. But the next day after I opened this, QQQ went from about $290 all the way up to $300 at the close. I still thought the markets could pull back, but then the next day, QQQ went up to $310, and I ended up letting these options expire in the money. And this is a big problem that I have in trading, where whenever we have these big pivots in the market, I usually just end up holding the trade and end up taking my maximum loss. So this probably could have been prevented by setting a stop loss, but by the time that I was ready to close this trade, QQQ had already been trading probably about $305, and I think I was already at like a $600 loss. So losing that extra $20 wasn't going to hurt too much. Again, I ended up taking a $620 loss after opening these for $38 in credit each. I ended up closing them at the maximum value of $100 each. I opened 10 of them, so again, $620 loss, which really sucks, but my biggest winner for the month was $290, and we find that trade that was on a SPY debit spread, put debit spread, assuming that SPY would be below my $405 strike price on my expiration date of May 13th. I ended up opening this the Friday before on May 6th. I ended up closing on Monday on May 9th, and if we look at the charts, whenever I opened this, SPY had been trading around $410. Again, I was assuming that it would be below $405, but then the next Monday, the markets had gapped down all the way down to about $390. And at this point, I had made most of my profits, so I decided this is the point to get out. I paid $210 in order to open these, and then I closed them at $355. I ended up opening 2 of these for a profit, again, of $290 for this trade. And finally, the last trade that I wish I'd held on to for a little bit longer was this NVIDIA call debit spread. So NVIDIA had the earnings report on May 26th. If we go over to the charts, I opened this the day before the earnings report when NVIDIA was trading all the way down at $160. I thought for sure that it's going to recover because all the chip stocks that I've seen so far in this earnings season have done really well in the earnings report, and I thought NVIDIA would probably do the same. So I ended up holding through the earnings report, ended up dropping a crap ton, and then recovering all the way back up to $180 the next day. I ended up closing this, I think the first hour of the day right here, when NVIDIA was trading around $172. But had I ended up actually holding this, I could have made my maximum profit, which really blows. I was assuming that it would be above my $175 strike price, and if we look at this trade, I ended up opening these for $189 each. I opened 3 of these, so spending almost $600 to open this trade, and I ended up closing them at $232. Whereas if I held this, I could have turned that $600 into about $1,500 for $900 in profit. But unfortunately, I only took about $129 in profit, so I left a lot of profit on the table. But again, whenever the markets see these big pivots like QQQ did, Nvidia saw the same exact thing. So that's why I ended up selling myself short. Overall, this was still a great month for me, making $1,100 in profit. My win rate for the month was 77%. I made a total of 35 trades. This was one of my busiest months again, 27 wins. 8 losses, $3,100 in wins versus $2,000 in losses. And again, this year has been going pretty well. But what I've noticed is the more trades that I take on, it seems like the lower my win rate. So again, this is one of my busiest months, 35 trades this month versus only 24 trades in April. And in April, I had an 87% win rate, whereas this month I had a 77% win rate. And if we look at March, I had a 78% win rate with 32 trades. Whereas in February, I took 26 trades and my win rate was 80%. So maybe it's time to back off a little bit, not take on as many trades for a higher win rate. But for June, these are the trades that I'm looking to make. These are a few of the trades that I have open right now, but this is the trade that I'm looking forward to the most, this UVIXI put option. So this expires next week, and I'm assuming that UVIXI will be below my 1250 strike price on my expiration of 610. And if we go over to UVIXI, the reason why I took this trade is because I'm assuming next week we're not going to have any major catalysts. So volatility is going to continue to come down, and the reason why I chose the 1250 strike price was based on the VIX. Right now, VIX is trading around $25, and I think that VIX should be trading probably around $23. So that would be about a 10% drop for VIX, which will translate to a 15% drop for UVIXY because it's leveraged by 1.5 times. So with UVIXI trading at $13.50 right now, if we subtract 15% from that at 85%, UVIXI should be trading around $11.50 based off of this thesis. Now, of course, I could be wrong and volatility could go up from here, but I didn't put a lot of money on this trade, luckily. So if we look at the trade, I opened 5 of these at $34 each, so I'm spending a little bit more than $150. But if this trade goes to plan, this is going to turn that $150 into around $500 if I'm right about it. And the way that I'm calculating this is taking my price target of $11.50, subtracting that from my $12.50 strike price for an intrinsic value for these options of $1. So they would be worth $100 each after I bought them for $34. And since I bought 5 of them, that would turn $150 into a total of $500. But that's if the trade goes to plan. I also have a Tesla put credit spread, assuming that it's going to be above $730. And this trade I'm actually looking to get out of right now because of the news of Tesla laying off some of their workers. The news report said that it was 10% of their workforce, but it was actually only 10% of their salary workforce. But right now, Tesla is trading at $703, so it might be a little bit hard to get back to $730. But if UVIXY comes down like I'm expecting, that should translate into SPY and the overall market going up, which should translate into Tesla going up as well. And usually Tesla amplifies whatever the market does because it has a high beta. So if the markets go up a few percent next week, it would be easy for Tesla to recover over $730. But right now, sentiment is not great because of the layoffs, so I wouldn't be taking this trade again. But another trade that I'd be looking to take this month is based on the Fed meeting as well as the Federal Reserve starting to sell off their balance sheet. So if we look at the last time this happened, this was in March of 2018 where they decreased the balance sheet from $4.3 billion all the way down to $3.7 billion over the course of about 6 months. So if we go to the same time frame, TLT started at around $120, and then about 6 months later, it had been trading at around $113. So my assumption is that TLT will probably start to come down once the Fed starts selling off these bonds and it starts coming off their balance sheet. But 6 months seems like it's too long to wait. So what I'd be doing is setting my expiration date for shortly after this is going to start coming off their balance sheet. I think it's on June 15th. So I'd set my expiration date for June 17th, a couple days later, and then I would be doing a call credit spread. And whenever I open a call credit spread, the way that I do this is I usually look for a delta value between 20 and 30 based on the price action. And TLT is down pretty hard over the last day, so I'd probably be closer to 20. And if we look at the 118.50 call, this has a 30 delta, so that's too high for us. But if we look at the 119.50, this has a 22 delta. So we could sell the 119.50 call, buy the 120.50 call. So we're assuming that TLT will be below our 119.50 strike price on the expiration date of June 17th. And we're going to get paid a total of $17 in credit, but we are risking $83 for each of these that we open, which is pretty significant. But another trade that we can make based on what TLT did back in 2018, it ended up actually trading flat for the most part for about a few months after the Fed started selling off the balance sheet. So we could actually turn this into an iron condor, which would make this a little bit less risky. And again, the way that I would do this, find another 20 delta. So looking at the 112 put has a 17 delta, so that's a little bit too low. But if we look at the 113, 23.6, we would sell this put option in order to open it. We would buy back the 112, and in total now we're going to get $38 in credit, which means for each of these that we open, now we're only risking $62. But TLT is going to have to be between our strike prices of the short options, so between $113 and $119.50 on our expiration date of June 17th. But if it's below $112 or above $120.50, then we would end up taking our maximum loss, which would be $62. But there's about a 60% likelihood that it's going to end up between our strike prices and end up taking our maximum profit of $38. So we'll see how this trade ends up playing out. Again, the last time that this happened, TLT ended up pretty flat for about a few months. So if the same thing plays out, this could be a decent trade to take on. But that's pretty much all I have for you today. Thanks for making it all the way to the end of this video, and thank you to all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.